Why in the world would I pay myself money with interest? Seems crazy, and I'm probably losing a bunch of money. Let's get into that conversation right now. What's up, everybody? JDew and Jonah here of the Banking Bros at the Cash Compound, ready to tackle a question so many people wonder about. And this question baffled me. It baffled you, I think, probably when we first started.
That's right.
So, ladies and gentlemen, remember what we do here on this channel at the Cash Compound and the Banking Bros, depending on where you're watching from. And if you are watching, you see we're in a new studio on the vodcast. If you're watching on the Banking Bros channel on YouTube, welcome. But many of you are just listening to us, so we are in a new studio. Jonah, would you describe it? Paint a picture.
Studio looks a lot like an office park space, but we're here.
But that's not what you see in this camera angle.
Oh, sure. I describe it as neon, glowing, podcast-esque. Makes you really think we're deep thinkers.
Yes, indeed. So, ladies and gentlemen, the point is, go on over to YouTube if you're not subscribed on our channel over there and follow us. Welcome back to all of those of you who like to binge us over on the podcast side. So, what we're going to talk about today is this topic that takes us one step further into understanding what we have learned as the infinite banking concept. What we do here on this channel is we help folks crack the code to cash flow. And what that means is we're going to utilize one tool, just one thing you're missing. And if you understand it well and you use it right, you're going to be able to maximize your wealth and be able to do a lot of great things.
Yeah, so today's topic is all about repayment of loans. What's happening when you repay? Why in the world would you repay? Should I repay tomorrow? Should I repay in a year? Like, just repayment. What's happening? I get this question pretty frequently, because in my opinion, it's actually probably one of the hardest to understand topics.
Agreed. Yeah.
You might get a lot of the other stuff as it continues and as it starts, as you're learning and practicing infinite banking. But when it comes to repayment, your brain just will do like somersaults on you as you try to understand it. And it's really easy, but at the same time, it's just not, because
it's not intuitive.
Yeah, like
it's
what
not
in the world?
Yes. So that takes us right now into our quote of the week. Our quote of the week is coming from Nelson Nash himself. Remember, he is the curator, the inspiration behind the infinite banking concept. He realized that while he was paying for this, of all things, ladies and gentlemen, whole life insurance, he created himself unknowingly a bank. So the quote is, you finance everything you buy. You either save up all your money in cash, pay for stuff, it goes to zero, or you pay someone else interest. But here's what we're talking about today. We're trying to figure out how we can be all the players in the game.
That's right.
All the players in the game, and that'll fix this. So appreciate that once again from Nelson. And let's get into this. So the other kind of, maybe a little bit of a quote here, Jonah, is what we like to call rule number 2 around here. Remind us what that is.
Sure, it's pay yourself back with interest. So I've actually changed that rule a little bit, changed my phrasing.
Okay.
I've started saying pay yourself back with extra. Okay.
Oh, okay.
And here's why. Why I say it. Well, it's part of that counterintuitiveness.
Okay.
If I say the word interest, your brain will trick you more. If I use terms that you're familiar with in other areas, your brain will trick you more into thinking like that other area, so therefore you kind of rationalize a few things. But if I start saying pay yourself back with interest, pretty much everybody gets it. Here's an example that I've used pretty frequently. Yep. I said, so pretend you're going to walk into the bank and you're going to ask for money for a house. And right behind you in line is Jeff Bezos. Walks into the same bank and asks for money to buy a house.
He did this? No, that was Elon Musk. Like, he was talking about buying houses a year ago.
Okay, I don't remember. But here's my question for you. Regardless of interest, that's why I kind of threw the word out. I'm just talking about extra. My question is, do you both have to pay the bank back all of the money that they gave you plus extra?
Yes, you do.
Yeah. Now, one person's extra might be less than another person's extra, but that's not what extra means. Extra just means more than what they gave you.
Yeah, so one thing that you're mentioning on that one, which a lot of people like to jump into, is the rate. But we're not talking about the rate so much on this episode. And in banking, that's not really all what You think it is. Everyone just focuses on
yeah, I mean, I'd venture to say
right.
that's not actually in the equation. Actually, the bank's equation is just you have to give us the money back plus extra. That's the equation. Because think about it. They'll loan the money, if they loan the money to you for a house and they also loan the money to Jeff Bezos for the house, there's different rates, right?
Yeah.
One person might just give a little extra, probably Jeff, right? And one person probably give a lot extra, probably you, right? I mean, that's how it works.
Right.
But
We're going to
extra,
assume he's going to buy a different house, maybe.
Yeah,
but if we're buying the same house, we all get it. Yeah.
But it's just extra.
Yeah.
You
Yeah.
both have to give back extra. And also, I like to say extra because it throws out that time period as well. Consumers really focus on that a lot.
Oh, yeah,
they go,
Right.
well, when I get loans, I always get 10-year terms, so I don't have to give them back so much. And I'm going, that was not the equation. The equation was, do you give them extra? That's all I want to know.
So here's the question. When you're not saying extra, and we're normally saying rule number 2 around here historically is pay yourself back with interest, where does it take people?
It takes...
help us understand why you changed it, what they're thinking.
Well, most people get a little confused because they associate that word interest with the interest charged by the insurance company. And so they say things like, well, if I want to pay myself back 5%, I guess that all just goes to my company. And it's like, no, you confuse two different things. Does that make sense? So I've eliminated the word interest. We'll use that in a different area and started saying the word extra. When you take out $100 from a conventional, traditional bank, they charge you more than $100 on the way back when it comes back.
Right.
Take out $1,000, they charge you more than $1,000. And here's the greatest part. Everyone's extra could be different from their experience with conventional banks. I could say, hey, when you borrowed your money for your last car, how much did the bank charge you? And someone could say 5%, and the next person says 10%, and they're both correct. Because the bank did charge that person 5% and did charge the other person 10 for the last car.
Right.
But that wasn't what the rate wasn't the equation, and what the terms of the rate or terms of the time wasn't that equation either.
Right.
The question was, did you give them back extra? That's what we wanted to know.
Right.
And the reason I'm bringing that up is because that's how banks make money. So it's a process where it's got 2 steps, and the steps have to go in the correct order. So here's sometimes what I've said to people as well. Would you willingly, Jeremiah, really willingly send Wells Fargo a check every single month? Willingly send them a check if you never borrowed money from them in the first place?
Absolutely not.
Absolutely not. No one would, right?
Right.
And the second question is, when Wells Fargo sends you money, right? Would Wells Fargo give you money without forcing you to give them back the check, pay it back?
Would they loan out money?
Would they loan out money without asking
right.
for it to come back?
Absolutely not.
Absolutely not. So it's a 1, 2. You can't do step 2, pay back without a loan.
Yeah, okay.
And no one in the right mind gives a loan without expecting the payback.
Right.
It's step 1, then step 2. That's how you make money.
I have that conversation with people all the time as well, and I say, what happens when you take loans and you pay them back, and you pay them back with interest, with extra? I ask this question to people. So why do you think the bank does that? What's in it for the bank?
Yeah.
What do you think people say?
That's how the bank makes money.
That's how the bank makes money. Now, Jonah, what if you own the bank?
Then that's how I'd make money.
Then that's how you'd make money. So we're trying to break it down for you, ladies and gentlemen. So appreciate that. Jonah, so what we've got for you today is a little bit different for those out there in podcast land, wherever you like to listen and subscribe from. We want to get into some numbers, actually. We don't get into lots of numbers, but we are going to have visuals on this. So we're going to chat about an actual payback with extra schedule.
That's right.
That we have put together. And so if you want to hop over into another platform and see this, we will try to be clear, of course, on the audio world. There's a lot of truckers who are listening to us out there.
Oh, very cool.
There's a lot of people who are in the trucking, but we are going to help you understand where you start and where you finish if you actually follow rule number 2.
That's right. So basically what we've got is a policy that's starting with a $5,000 premium. Okay. So when we relate this to our cups, right, our 3 cups setup,
cups, right?
What does that mean if I say a $5,000 premium? Where's that money going, and what's special about the cup that it goes into?
Got it. So I know this one, ladies and gentlemen. When we say premium, remember, premium and deposit sometimes get interchanged because we are building a bank, and when we put dollars inside the bank, we love deposits. It makes us all smile and feel good on the inside. That is cup 1, red cup premium.
That's right. And what's special about that cup?
What's special about cup 1, red cup, in the 3-cup setup, where the premium deposits go, ladies and gentlemen, is that everything that goes in there has guarantees, including compounded interest.
That's right. While that cup has $5,000 in it now, because that's how much we're going to put in there, we've also got cup 2, which is what we like to call cash value. Well, the reason we separate it into cups is so that you at home understand that it is a completely different pool of money.
Jonah, you got intense right there for a second.
Because so many people miss this.
Right.
It's a completely different pool of money. If you've got 2 cups in front of you
Right.
and you drink all the Kool-Aid out of cup number 2,
right.
how much Kool-Aid is still in cup number 1?
All of them.
All of the Kool-Aid. You
Right.
didn't drink that one, right?
Correct.
It's the same thing going on here with the cash value.
Yes.
I can spend all the cash value, that's fine, but since it was in a different cup, how much money's still in my premium deposit cup?
All of the Kool-Aid.
All of the Kool-Aid. There it
Right.
is, right. Okay, so in this example, you put in $5,000 in your premium cup. In the cash value cup, different
Cup
pool
two,
of money,
cup 2
there's
green
around
cup out there.
$2,600 that's available in the cash value cup.
Okay, so this is assuming, so those of you who are wondering, this is also then assuming like year 1, right?
Oh,
There's
yeah.
Year
Just
1, we just started this
fresh.
policy.
Yep.
So,
And again, just in case you're unfamiliar, as you can put more money, as you pay more money into your premium, like for instance each year.
Right.
So in this case, if you did $5,000 again in the second year,
right,
that would be a total of
$10,000 in cup 1 red cup premium deposits.
there it is. And in cup number 2, last year in cash value, they gave you about $2,600, and generally they'll increase that.
Yes.
So in the second year, you're going to
Not
get
generally, guaranteed it'll increase.
That's correct. I
Yes,
said the
yes.
wrong word.
Okay.
Guaranteed they'll increase it.
Yes.
And so in the year 2, in this particular example, they've got about $2,800 new money
New
in
money
the cup.
on top of the 2,600 old money.
That's right.
Okay.
So what happens in this example is this person wants to use the cash value to pay off a car that they had.
Okay.
It was a BMW. They owed $8,200 or $8,500 on
right.
it, I'm sorry, when they got their policy. They paid for their policy 2 years in a row,
Okay.
just like we talked about. So $10,000 in their premium and 26 plus 2,800 in their cash value.
That
So
the
they're
insurance company put it in there.
Yep.
It's a separate pool from the 10 grand they put in, ladies and gentlemen.
That's right. So their cash value is now at about 5,500.
Okay.
Premium at 10,000,
Yep.
cash value at 5,500. Well, in doing this, they continued to make their car payment. They had a car
Right,
before
okay.
they started. They had car payments. They continued to make their car payments. And 13 months later, keep in mind 13, this is important. So in the
Okay.
first month, they paid their $5,000 premium.
Boom.
And the 13th month, they paid a $5,000 premium. They paid their premium all up front.
Yeah, annually. Premium.
So they've
Okay.
paid their premium twice,
Got it.
which means their cash value is like $5,500 now.
Got it. Yep.
And on their car, they actually only owe about $4,900 now.
Because they've been paying their
because they
monthly
had to pay
payments.
it 13
Yes.
months worth.
Okay, cool.
So what they actually have is the ability to take a cash value loan out of their policy and pay their car completely off.
Okay.
13 months later, car is paid.
So, ladies and gentlemen, I hope you understand that part so far. They've built their system for 2 years, not 2 full years. They paid it up front. So, month 1, month 13, they have enough cash to pay off a bill. It happens to be the car. So, now what happens, Jonah?
Yeah, so what happened is basically they paid off their car in 13 months
Okay.
instead of the original length of time that BMW would have charged them
Gotcha.
to pay the car.
Okay.
Which we know is 31 months.
All right.
Just based on the value of the price that they had left on the car to pay.
Gotcha.
So instead of 31, they paid it off in 13. That's 18 months that they do not have to make a $300 car payment to BMW, right?
Yes.
Don't have to make it. They were planning to make it. They told BMW they'd do it, but now they don't have to.
Right.
So next month, when they go to pay $300 to BMW, oh, wait, they don't have to. $300 is still in their pocket. You don't have to give it to BMW. Your car's paid off.
Of course.
Who would do that?
Right.
Right? I asked you that earlier. Who
Yeah.
willingly gives BMW $300 when there's no loan? No one.
Not
right?
us.
Right. They wouldn't do that.
Look at us.
So what we encourage people to do is take that same $300. This is the meat of the podcast here.
Okay.
It's the same $300 that they were paying to BMW. So it's no different on their monthly budget. Sometimes people get a little confused. They say, Jonah, if I'm going to repay, it's extra money. It's extra money if I'm going to repay. And I say, no, not extra.
No, you had already had 18 months of payments.
Yeah, you already agreed to pay
okay,
that $300 to BMW.
People
this
do
is not
miss
extra.
that a lot. I think I miss that a lot.
It's not extra.
Give them a little grace, though.
Yeah. So what we suggest is you put that $300 back inside your policy as your repayment. Here's the fun part. 300 times 18. 18 is the amount of months that you would have paid BMW that you don't have to anymore.
Right.
300 times 18 is 5,400.
5,400. Now, ladies and gentlemen, let's stop here for a second because I'm getting asked this a lot, especially when I'm going live lately. Paying back to your policy means that you filled out the one-page form online for loan repayment, or you called customer service and said, hey, will you go draft? Here's accounting, here's routing, and take some dollars from my Wells TD Truist,
B of A, Chase,
B of A,
put it back in my
put
policy.
it in the policy. I'm going to repay some loans. That's all that means. Sometimes people wonder.
That's right.
Yeah. Okay.
So now instead of paying BMW 18 more times, $300 a month, you're just going to pay your policy 18 times, $300 a month.
So same amount of money.
Same amount of money, no extra, right?
Yeah.
But here's the fun part: we only took $5,000 out of the policy to pay off the car,
right?
And 300 times 18, 300 is the car payment, 18 is the amount of months left. 300 times 18 is 5,400. So even though we only took out 5,000, we're going to end up putting back in your policy 5,400. So here's where it gets fun again, and here's why we brought up our cups at the beginning of this episode. We just talked through it with the cups. So since you took 5,000 out of the cash value,
right,
5,000 is what's allowed to go back in the cash value. Where in the world's the extra going?
We're done. So where does that extra go?
The extra goes in cup number 1, the
where
premium deposit cup. So instead of 10,000, right?
Yes.
5,000 from the first year, month 1. 5,000 from the second year, month 13. Instead of 5,000, there's 5,400 in the cup.
Yes.
The cool part about that, again, what's special about cup number 1?
Is everything that goes in cup number 1 has guarantees, including compounded interest.
That's correct. And so what happens is now, instead of only earning off 10,000, I'm earning off 10,400 for the rest of my life. Every year. It's not like my 400 went away, right? When I put in 5,000 again to my policy at the start of year 3, month 25, what's my new total?
Your new total is 5, 10, 15, 4.
15,400. My 400 didn't disappear.
Correct.
It's still there, just like your 5,000 was still there, right?
Right.
And so what happens is a $400 injection, infusion, $400 extra because you repaid, which, keep in mind, was not extra money for you. It was the same $300 a month you were going to give to BMW. The same. It was exactly wasn't extra. Right. But that $400 can do thousands of dollars worth of growth
over time
in your policy.
Let's go.
Depending on how long you're around.
Yes, right.
Depending on how long your policy's going.
Such a big deal for folks to understand. When you pay back with interest, with extra, the extra goes inside the premium cup, cup 1, red cup, if you're the visual out there. And you don't just get the 400, Jonah. You get everything the 400 grows to for the rest of your whole life.
That's it. That's the power of repayment. Again, people ask, why in the world would I repay? Why in the world would you not repay? In this example we've given to everyone today, did you come up with extra money? Did you work more hours? Did you work harder? Did you take money out of savings to repay?
You did not.
No.
None of those things.
I just stopped paying BMW because I paid them off early. And I took that same money that was going to BMW and put it in my policy.
It's so tough for folks to get, though. That's why we're trying to break it down for you. We know that you struggle with this concept because we were in the same place as you. And why we've created all these visuals and these examples and we explain them the way we do, ladies and gentlemen, is because we also were in your shoes just yesterday trying to figure out the same game.
That's right.
So that's what's going on. So I believe we've been showing them visuals here. Obviously, we have to do a little bit of that in post-production. Is there anything else you wanted to say about how those numbers ended up with this person in particular? Because we're actually using our examples, as you know, on our YouTube channel. We've got examples from real customers and clients.
Yeah, that's right.
We're trying to break down, we're trying to protect the wealthy, but we're trying to break down things that we've been asked and we walk people through so you understand how even one purchase throughout your policy's use. Just one purchase, one car they already had. will make you wealthier.
That's right. Really, all I'd say is we've got more examples of this on our YouTube channel. We actually have a YouTube video that should probably match this example that we're walking through, and we'll put a link above us somewhere so you can go watch it. And just like Jeremiah said, the crazy part is one purchase makes such a difference, and you can do so many more than one purchases. Keep going. Do 2 purchases at a time.
Well, you need new BMWs,
3 purchases. Buy the car, again, another car next year. You can do so much more with it, which all it does is increase the value, the cash values, the death benefit, the premium deposit, the amount of money you can take out in retirement. It just increases everything as you continue. And so when people ask me, why in the world would I repay? My answer is, why in the world wouldn't you?
It's tough to understand, but we hope we broke it down in a way that makes you feel good on the inside about repaying your loans and using your bank as a cash flow machine for yourself and paying yourself back with extra. I love it. So remember to follow rule number 1 and get your policy started. We'd love to help you do that here at the Cash Compound and the Banking Bros. We're on standby all the time, taking calls and helping people get started with that process. Find a link, pop on our schedule, and we'll chat very soon. And don't forget rule number 2, pay yourself back with extra once you take those loans. We'll talk soon.